Tonight we are looking at variance analysis. Kindly confirm you can hear me so that you can proceed.
Yes, I can hear you.
All right, let's go to the business. As much as possible, let us try to listen. What is variance? If you are to define variance, variance can be defined as any deviation from a standard. If to define variance is any deviation from acceptable standard. The word variance is, please let's continue. We are trying to define variance as deviation from acceptable standard. The word variance is rarely used on its own. It must be quantified. You can have cost variance. If you have to define cost variance, the differences between expected cost and the actual cost. You can have revenue variance. Revenue variance is the difference between your budgeted revenue or your expected revenue and the actual revenue. You can have profit variance. Where your budgeted profit from actual profits. Variance reporting is used by management. Variance reporting is used by management to identify areas of deficiency so that management can take action to correct the problem as early as possible. Now we have, please, you are going to take down this formula. We are starting with cost variances. Please, you are going to take down these formulas. We start with cost variance. Under cost variance, we have direct material cost variances. This can be subdivided into two. You can subdivide this into two. Into one. Direct material price variance. If you are to calculate direct material price variance, what is direct material price variance? Where there is differences between your actual material price. Where there is differences between the actual material price and now look at the formula for direct material price. The formula is standard material price minus actual material price multiplied by actual quantity. Actual quantity of material purchased. Please, you may take it down. At any point in time, you are asked to calculate direct material price variance. Pick the standard material price, minus it, actual material price. Then go and look for actual quantity of material purchased. My advice is to write it down. Number two, direct material usage variance. What is direct material usage variance? Where the actual usage is lower or higher than the standard usage. Material usage variance occurs in a situation where actual material use is different from the standard material. To calculate direct material usage variance, the formula is standard material for actual production minus actual material used multiply by standard material price. That is how to calculate direct material usage variance. Please document this in your notes. On your exam, directly solve question on this. We are done with direct material cost variance. Next, number 2, direct labor. Cost variances. We can divide this into 2. Under here we have direct labor rate variance. What is direct labor rate variance? Where the actual rate paid to workers is different from the standard rates. Where the actual rate pays to workers where the actual labor rates paid to workers is different from the standard rates management has approved. That will give rise to direct labor rate variance. If you have to calculate this, the formula is standard labor rates per hour minus actual labor rates per hour, close your brackets, multiply by multiplied by actual labor hours. That is how to calculate direct labor rate variance. Number 2, we have direct labor efficiency variance. What is direct labor efficiency variance? Where the actual hour used for production is different from that hour that should have been used for production. For example, management says if you have to produce a bottle of Coke should take you 1 hour. Management has recommended 1 hour to produce 1 bottle of Coke. That is the standard hour. Any employees that uses more than 1 hour will be assumed to be inefficient. If you have to calculate this variance, the formula is standard labor hours for actual production minus actual labor hours used, then multiply by standard labor rates. That is how to calculate direct labor efficiency variance. If you are documenting it down, it's fine. By the time we are solving questions, this is the formula we are going to be using. But if you are not documenting it, there must be a way you are going to get it. Let me expand this. That's why all right, let's continue. We have explained direct material cost variance. We have explained direct labor cost variance. Number 3 category. Variable production overhead variances. You can divide this into two. Over figure 1. We have variable production overhead. Expenditure variance. Where your variable overhead expenditure, where your actual variable overhead cost incurred is different from the expected variable overhead cost. If you have to calculate this, variance, look at the formula, please. Actual labor hours multiply it by variable overhead absorption rates minus actual variable overhead incurred. This is how to calculate variable overhead expenditure variance. You are going to pick the actual labor hour. Then you are going to multiply it by the overhead absorption. Your variable overhead absorption rates will be given to you in your standard table. And when you get your answer, minus actual variable overhead incurred. We also have number 2. Variable production overhead efficiency variance. This variance is to measure efficiency. If you are to calculate this, the formula is standard hours standard hours, standard labor hours. Standard labor hours for actual production minus actual labor hours used multiplied by variable overhead absorption rate. Your variance can either be positive, that is favorable, or adverse. We are done with variable overhead. We now have number 4 category. Fixed production overhead variances. This can be divided into two. This can be subdivided into two. One, you have fixed production overhead expenditure variance. Where your budgeted fixed overhead is different from your actual fixed overhead. To calculate this, the formula is budgeted fixed overhead minus actual fixed overhead. Your budgeted fixed overhead cost minus it from your actual fixed overhead cost incurred. That will give you fixed overhead expenditure. The second one is fixed production overhead volume variance. Your fixed overhead, fixed production overhead volume variance. If you have to calculate this, actual production volume actual production volume. You have a figure here. Minus budgeted production volume. You have another figure here. You look for the differences. The differences. You have a figure here. Then multiply the difference by fixed overhead absorption rates per unit. If you multiply these two, you are going to get a figure here now. This is your final answer. We have explained all the cost variances. Now move to sales variances. We have explained all the cost variances. Our next explanation is sales variance. Remember your variance. You can either have favorable, represented by letter F, or you can have adverse, represented by letter A, or you can have zero. sales variances. Here we are looking at revenue. Sales variance is revenue variance. What we are trying to measure here is where actual revenue is not the same as the budgeted revenue. Management can ask you to investigate why the actual revenue achieved at the end of the month is not the same as the budgeted revenue. Your investigation will involve variance analysis. Under sales variances, we have two. One, we have sales price variance. Where the actual selling price is different from the standard selling price. To calculate this, actual selling price minus standard selling price. When you get the difference, multiply by actual quantity sold. That will give you your sales price variance. Then number two, sales volume variance. Calculated as actual quantity sold minus budgeted quantity multiplied by standard profit per unit. At times, if the question is on marginal costing, then you are going to use standard contribution per unit. Examiner can either text you on absorption costing or marginal costing. If the question is on absorption costing, you are going to use standard profit to multiply it. If the question is on marginal costing, then you are going to use the question is on marginal costing, then you are going to use standard contribution per unit. Standard profit is equal to standard selling price minus standard absorption cost. Standard contribution is equal to standard selling price minus standard marginal cost. We are done with the explanation. Any question, please? We are done with the explanation. Any question, please? All right, refer to your material, illustration 4. I'm trying to create a space. Please, can we check illustration 4, page what self? The question on the bend. Please, can somebody confirm the page? Can somebody confirm the page?
Page 107.
Page 107.
7.
Page 107. David, please, can you read?
Okay, sir. Defense Nigeria Limited
Thank
job costing system has two direct cost categories: direct material and direct manufacturing labor. Manufacturing overhead, both variable and fixed, is allocated to products on the basis of standard direct manufacturing labor hours. At the beginning of 2016, Defense adopted the following standards for its manufacturing costs and sales. All figures assumed to be correct. The denominator level for total manufacturing overhead per month in 2016 is 40,000 direct material labor hour. The Defense flexible budget for January
that
2016 was based on this denominator level. The record for January indicates the
denominator
following.
level for 2026 is 40,000 direct labor hours. Please go ahead.
The Defense flexible budget for January 2016 was based on this denominator level. The record for January indicates the following. All figures assumed to be correct. The proportion of actual variable and fixed overhead cost is the same with the standard. Within the standard required. Please scroll up, sir.
Okay.
Calculate the budgeted profit for the company for the month of January 2016. B. Calculate the following for the month of January 2016. I.
Let's deal with
Direct.
A. Let's deal with A, don't worry.
Okay, sir.
Requirement A says, calculate the budgeted profit for the month of January. Your budgeted profit is, if you have to calculate budgeted profits, your budgeted profits is equal to budgeted quantity, budgeted units, multiplied by the standard profits. The standard profit per unit. Why I pick this question is because examiner played trick on students. If you look at the question throughout, you are given two sets of tables. the first set here. This is the standard where you have budgeted information. Second table is the actual. Now, examiner didn't give us the budgeted units directly. Examiner says look at the word here. The denominator level for total manufacturing overhead per month in 2016 is 40,000 direct manufacturing labor hours. The then flexible budget for 2016 January was based on this denominator level. That means our budget is based on 40,000 hours in a month. And if you also look at the schedule, examiner says direct manufacturing labor, 5 hours at 200 naira per hour. That 5 hours represents the hour required to produce 1 unit. Now, if you have 40,000 hours in a month, and you are going to produce one for 5 hours, how many can you produce? How many units can you produce in a month?
6,000.
The question is for the class.
6,000, sir.
8,000 units. That is how you are going to derive it. Most students could not tackle this problem in the exam. Without resolving this, you can't solve any question here. Without getting the budgeted units, you cannot resolve any problem here. So if you come here now, our budgeted units, our budgeted unit is got to 40,000 hours in a month, and to produce one, I require 5 hours. That means in a month, I can do 8,000 units. You have derived your budgeted unit. You now return back to the standard table. What is the standard profit? Look at this. Standard profit is 1,300 naira. Multiply by 1,300. If you work this out, your final answer will be 10,400,000. That is the budgeted profit for the month of January. We are done with that. We can now move to Requirement B. We are done with requirement A. Requirement B1. Direct material variances. Direct material variances. You are going to divide into two. Direct material price variance. Now look at the formula for this. Standard material price minus actual material price multiplied by actual quantity of material purchased. Look at the standard table. Direct material under standard 3 kg at a price of 500 naira per kg. Standard material price per kg 500 naira. Come to the actual record for January. Material purchased, actual price 520 per kg. Actual quantity 250 kg, 25,000 kg. Standard material price 500 naira minus actual material price 520 multiplied by actual quantity purchased 25,000. Please work this out. Negative 500,000 naira. That's your material price variance. That negative indicates adverse. Next, direct material usage variance. You look at the formula for this. Standard material for actual production and actual material use. Standard material for actual production minus actual material use, then multiply by standard material price. If you have to calculate this, standard material for actual production now let's look at the actual production. Look at the actual table. Actual production 7,800. To produce one, we require 3 kg of material. Actual production is 7,800. If you have to produce one, you are supposed to use 3 kg. So if you have produced 7,800, how many kg of material are you supposed to use? Yes?
23,400.
Correct. You are going to multiply 7,800 by 3. That is the standard material required for actual production. Look at it. 7,800 multiplied by 3 kg. That will give me 23,400 kg. That is the standard material required for actual production. Minus it from actual material use. Now go to the actual table. Direct material used, 23,100 kg. $23,100. When you get the difference, multiply by the standard material price per kg, 500. Please work this out. You have a favorable 150,000 favorable. You are done with material usage. That settles your direct material. Roman figure 2. Direct manufacturing labor variance. Labor variance. Again, you can divide this into 2. You have direct labor rates variance, where the actual labor rate is not the same as the standard labor rate. To calculate this, standard labor rate minus actual labor rate multiplied by actual labor hour work. So we go and start from your standard table. Look at direct manufacturing labor. 5 hours at 200 naira per hour. That is the standard labor rate per hour. Now come to the actual table. Under direct manufacturing labor, actual labor hour, 1 night. Actual labor hour work, 40,100 hours. You can calculate your rate variance. Standard labor rate, 200 naira per hour, minus actual labor rate, 190, multiplied by actual labor hour work, 40,100. What do you have here? 401,000. Favorable. Our plan is to pay labor 200 naira, but eventually we pay them 1 night. That means we have saved costs. The second one is direct labor efficiency variance. Direct labor efficiency variance. We look at the formula here. Standard labor hour for actual production. Standard labor hours for actual production minus actual labor hour used for actual production multiplied by the standard rate per hour. Our actual production is 7,800. And to produce one, management said 5 hours. So how many hours are you supposed to use?
39,000.
That is, you are going to pick that 7,800, multiply by 5 hours. That means if I have produced 7,800, I should have used 39,000 hours. That is the standard labor hours for actual production. Look at it here. 7,800 multiplied by 5 hours. That should have equal to 39,000 hours. Actual labor hour use 4,100. That means the employees are not efficient. Multiply this by standard labor rates per hour, 200 naira. Please work this out and give us the answer.
$220,000.
To what?
220,000.
340.
220. $220,000, sir.
Oh, 220.
Adverse.
Adverse. $220,000 adverse, negative. You are done with Roma figure 2. Roma figure 3. Variable manufacturing overhead variances. We can divide this into 2. We have variable overhead expenditure variance. This one. If you refer to that formula, your actual labor hour multiplied by the variable overhead absorption rate. Actual labor hour is 40,100. $40,100 multiplied by variable overhead absorption rates. Let's go to the standard table. Look at it. Variable overhead at a rate of 120 per standard labor hour. Look at it. This is the variable overhead absorption rate per labor hour. 120. multiply this by 120. You are going to get a figure minus actual variable overhead. Total actual manufacturing overhead, fees and variable, 12 million. That means we need to separate it. The proportion of actual variable and fixed overhead cost is the same with within the standard. If I now want to separate, I'll go and take proportion in standard. Cost per unit here, 600 for variable, 800 for fixed. We need to separate the 12 million. Look at how to separate it. Look at it here. Variable is variable overhead per unit, 600. Fixed overhead, 800. If I sum the two together, 1,400. If I now want to share 12 million, actual variable overhead is 600 over 1,400 multiplied by 12 million. Actual fixed overhead. Actual fixed overhead is 800 divided by 1,400 multiplied by 12 million. When you work this out, you are going to get a figure for variable, a figure for fixed.
Variable.
Yes, 5 million.
442,000.
For
142. 5142.
142,
857.
857. Now guess for fixed. 6 million.
Six million
Yes.
857
857.
857
857.
142 or
143.
143. Yeah.
You can now return back to your calculation. Actual variable 5,142,000. $5,142,855. Now calculate this. $4,100 multiplied by 120. That will give us 481200 minus 5,142,857. The difference minus 5,142,857. 33,857. You have 33,857. Add fast. You have calculated variable overhead expenditure. Now look at variable overhead efficiency. Variable overhead efficiency variance. The formula is standard labor hours for actual production minus actual labor hour multiplied by the actual, multiplied by variable overhead absorption rates. You have this figure already. Standard labor hour for actual production. Our actual production is 7,800 units. And to produce one, we require 5 hours of labor. That means standard labor hours for actual production should be 39,000 hours. Minus actual labor hour use, 4,100. When you get the difference, multiply by the variable overhead absorption rate per labor hour, 120. If you work this out, you are going to have a negative sign. 39 minus 40, 100. Multiply by 120. 132,000 adverse. 132 adverse. We are done with that. The examiner says calculate fixed manufacturing overhead variance. Fixed manufacturing overhead variance. This we can divide into two. Fixed overhead expenditure variance. That is your budgeted fixed overhead cost minus your actual fixed overhead cost. To get your budgeted fixed overhead cost, pick your budgeted units. To get your budgeted fixed overhead cost, pick your budgeted units. Look at it. Budgeted fixed overhead is equal to budgeted units 8,000 units. Now multiply it by fixed overhead per unit. Go and check the standard table. The fixed overhead rate per unit. And please be mindful of this. There's rate per labor hour. There's rate per unit. Look at this. In this case, you are going to pick 800. Cost per output unit. Multiply this by 800. That will give you 6,400,000. Then minus actual fixed overhead. That will give you, we have done it. Actual fixed overhead, 6,857,143. $6,857,143. The difference between these two. $6,400,000 minus 6,857,143 negative 457.
457,143.
457,143 adverse. That is your fixed expenditure variance. The last one. You have fixed overhead volume variance. Start with actual production. (7,800 units). Minus your budgeted production. That's 8,000 units. The difference between these two, that will give you a negative. (200 units negative). Now multiply it by the fixed overhead per unit. Fixed overhead per unit, 800 naira. That will give you negative 1/6. Final answer, 160,000 adverse. Oh, then I think we have one more. We are asked to calculate sales variances. There's one more. Sales variances. Sales variances. This can be divided into two. Sales price variance. Sorry, please. Sales price variance. Actual selling price minus standard selling price. Go to the actual table. Pick the actual selling price. The actual selling price is 5,350. The standard selling price is 5,200. Actual quantity sold, 7,800. Actual selling price, 5,350 minus standard selling price, 5,200. Get the difference? Actual quantity sold, 7,800 units. Final answer. Final answer.
One
1,170,000
1,170,000.
favorable. Then now do your sales volume variance. Please hold on. Document is saving. I want to click on save. Your sales volume variance is your actual quantity sold minus budgeted quantity. Multiplied by the standard profits. You don't click on save. It's saving all what we have done. All right, let's go on. Sales volume variance. Actual quantity sold, 7,800. Budgeted quantity, 8,000. Multiplied by the standard profits, 1,300. Please work this out. You have 260.
260,000.
adverse. You are done with requirement B. You can now do requirement C says prepare a reconciliation statement. Prepare a statement reconciling actual profits with the budgeted profits. 8 marks. Let's go to this. Requirement C. Statement reconciling actual profits with budgeted profits. You start with your budgeted profits. Budgeted profits. You calculated in A. 10,400,000. Now, pick your sales variance. Sales price variance. The figure here is 1,170. Favorable. Pick your sales volume variance. The figure here is 260,000 adverse. Please add the favorable, deduct the adverse. What do we have? Please, 10,400,000 plus 1,170,000 minus 260,000. What do we have?
11,310,000.
11,310,000. 310. Now go to cost variance. Cost variance. You have F for favorable, A for adverse. Be picking all the costs we have calculated. Material price variance. We got adverse 500,000. Material usage. We got 150 favorable. Then go to your labor rate variance. Labor rate variance. Let's check. That is what you are going to use for reconciliation. Favorable 401,000. Efficiency 220. Adverse. Labor rate. We have favorable 401. Labor efficiency. We have adverse 220. Go to variable overhead expenditure. Variable overhead expenditure. We also have variable overhead efficiency. Let's go and check. Variable overhead expenditure adverse 330, 857. Y efficiency 132,000 adverse. You come here. Three 857. 120 adverse. Now go and look at fixed. Fixed overhead expenditure and fixed overhead volume. Fixed overhead volume variance. This is 160 adverse. Variable overhead expenditure 457,134. Four five seven 134. Four 57143. Now sum up all your adverse and sum up all your favorable. All the favorable we give. The favorable will give us 551,000. Adverse 500,000 plus 220. Please let me sum up. Can somebody sum for us?
1,788,000.
1,788,000. That figure looks strange.
I don't know if there's any other
The 1
thing
million.
above that. I can't see that 220. I don't know if there's another figure before that 220.
There's a figure 500 plus 220.
Okay. That's 2,288,000.
2,288,000. 288.
Yes, sir. Then 3 zeros.
Your adverse is more than your favorable. Negative is more than positive. Now compare the two. What do we have? From your 288, deduct 551,000.
So we have 1,737,000.
All right. I'm taking the calculation again. The figure is because we solved this yesterday, and this figure is not looking like what I was giving. This efficiency variance, is it 120? Let me check. Efficiency variance is 132. 132 plus 132.
The total should be 1.8.
Four, 5, 7, 1, 4, 3. Plus 160. And whenever you say 2 million, I know there's a problem. Plus 160. The figure is not up to 2 million.
Yes, sir.
This is the figure we got, 1.8 million.
Yes, sir.
$1,800,000. Now minus 551,000. Yeah. Adverse. You have an adverse of 1,249,000.
0.000.
Your final profit now. This 11,310. $11,310 minus 1,249,000.
That's 10,061,000.
That is the actual profit. $10,061,000. You are done with the question. Actual profit. You are done with the question. Officially, we should close this class in October. We are not supposed to be having class in November. If there's opportunity next week, we take one more question. To look at other aspects of variance. I will be stepping out.
All right, sir. Thank you, sir.